Welcome to Common Sense Investing. My name is Cameron, and today I'm here to talk to you about microcap stocks because that's what I know, that's what I love, that's what I invest in. So that's what I'm here to talk about every week on Monday. I think I missed 2 weeks this year. I didn't have a presentation, a live stream on microcap stocks. So I'm pretty consistent, except for the couple weeks when I go camping and I simply don't have any Wi-Fi to do a live stream. I have a presentation, as always. Every week I come to you with a presentation talking about microcap stocks. And, you know, during this presentation, if there's any stock you want to talk about, any questions, any comments, anything at all, heckle me, you know, whatever, let me know in the comments as this presentation rolls around, because the back half of this live stream, I will get to questions, comments, and we'll just have a chat about whatever you want to talk about. I like this thumbnail this week. Free money. I love it. I love the greens, the green money. Why am I saying it's free money? Basically talking about it, you know, this right now, basically the markets are crashing. The microcap, the small cap markets are crashing. And we're getting Q3 earnings coming in. So when I'm saying free money, really I'm talking about free information. We're actually getting some really good information from companies on their earnings. Are earnings good? Are earnings bad? Are earnings flat? How's the economy doing? Are contracts coming in? We're getting all this fantastic information right now during the Q3 earnings season, able to make better decisions for what companies are going to do in 2026. And at the same time, share price has been down, right? Because the market's been so bad. So a lot of people hate this time of year because share price is down, everybody's losing money. I actually like it. I consider it free money because companies are improving and share price is not. As always, I am going to be talking about a lot of stocks today. I might say that I own some stocks. I might, you know, hint that I'm buying a stock, whatever it is. It's not financial advice. I'm not your financial advisor. So when I talk about these stocks, when I'm communicating about these stocks on this channel, it's really just my investing journey. It's basically a journal entry book on how I invest. I could be wrong. I don't know anything about you. I don't know your experience level, how much capital you're working with, if you've ever invested in microcap stocks at all. So please, if you have any questions, you know, make sure you contact a financial advisor. These videos are simply how I invest and not how to invest. I just like talking about microcap stocks and to have a platform to do that. And if you like microcap stocks, if you want to learn, or you're already a microcap investor, do not forget, go to commonsenseinvesting.ca and it will pitch you my Discord through either my Patreon or my Substack. You can get to my Discord through either funnel. And basically we talk about stocks all day. I absolutely love that platform. There's so many good investors in there right now. I'm having so much fun. So thank you to everybody that has joined so far. I really appreciate each and every one of you. And speaking about appreciation, before I get started, I just wanted to wish a speedy recovery to a couple of my fans out in the Canadian Maritimes, Don and Jen. We hope you get better very quickly. Thank you for watching my channel. Let's see, how important is this slide? Right? I made this plan a long time ago. And I always say with microcap stocks, build a strategy, right? Build a plan. Where do you think the market's going to go? Where do you think your stock's going to go? It's okay to be wrong. And what happens is as you gain experience in microcap stocks, you're going to be wrong less, you're going to be right more, right? And that's how you just learn it through trial and error. Every year is different, every stock is different, but over time you gain that experience. If you don't make plans, if you don't build strategies, you're never going to learn. So this has been my strategy for a while now, basically saying, because we had that late bull run, remember June and July was a really good time for microcap stocks. It was later than most years. So basically I expected kind of a lazy summer. We were going to have a little bit of a bull run here in the green due to Q3 earnings, but mostly the investor meetings. That was small cap discoveries in Vancouver at the end of September, and then Planet Microcap in Toronto mid-October. I thought those investor meetings would drive up the share price of some of our favorite microcap stocks. It did. It lasted for 2 weeks, right? We got maybe a 2-week bull run. And that's all we got during October. So that's a bit unfortunate. Now we are into the more challenging time for microcap stocks again. which is the Christmas season where people have less money, and of course tax season where people sell some stocks, some of the very good producing stocks that have gone up quite a bit in the year. People will sell those stocks to lock in some gains for capital gains, and some stocks that have gone down in the year, people will sell those stocks for capital losses to offset their capital gains, and they will rebalance their portfolio. So usually this time of year, from about mid-November to about mid-December, is pretty volatile thanks to these two reasons, right? People have less money, less time to invest, and they're more rebalancing their portfolio than anything else. Still though, my strategy, no surprise there, I am still pretty excited for 2026. I would like to see a little bit more of a return to normal in 2026. 2025 was a challenging year. U.S. elections, Donald Trump, trade wars, tariffs, shipping issues, contract delays, confusion. A lot of small companies struggled in 2025. It was a down year. Higher expenses. What was one of the common themes, right? Yeah, we still got some revenue growth, but we had to spend more to get that revenue growth. We had 10% revenue growth, but expenses went up 20%. We had 20% revenue growth, expenses went up 40%. That was a common theme in 2025. Can that normalize more in 2026? That is my expectation, and that is why I am somewhat excited for the year here. Info overload. All my energy is going into when chop causes drops. Yeah, there's a lot of information out there because we're back into this. This is when people do get information overload. Every time there's extreme fear, right? This time is different. I know the last time, Cameron, you were right. There was extreme fear, and you said, yeah, I like extreme fear. I put a smile on my face and keep buying some of my favorite stocks. But this time, Cameron, it's different. AI, they're having the AI bubble is going to burst. There might be a recession coming in. This time is different. So people get afraid again. And I'm saying here that so far in Q3 earnings season, I feel like I've been hit by a truck, but found a winning lottery ticket while lying on the road. There's a lot of companies where they reported good earnings and share price is down, or they reported weak earnings and share price is way, way down. I can like that. I can enjoy that. If I think a company is going to improve again in 2026, 2027, 2028, if my medium term and long term thesis is still bullish, sometimes I like, a quarter or two or even an entire year where you can get a share price decline, and it gives a potentially good time to buy some of my favorite companies. So not the end of the world for me. It's not even a major correction. It's funny to see fear at, 15 or whatever it is right now. Literally the S&P 500 right now is down about 3.88% from its 52-week highs. So this is the fear right here. Now, the problem with that is when the S&P 500 is down 4%, I know me personally, my portfolio since about November 1st is down about 11%. So that is the volatility of microcap stocks and small cap stocks. When the S&P 500 is down 4%, we're down 10, 11, 12%. That's just the way it goes. So unfortunately, that's what we have to put up with. But volatility can be opportunity. Heard an interesting theory today. The bear rises. The hypothesis is that over the long run, bears sleep easier and grow accustomed to the underperforming. Bulls get headline, but bears sell books. Yeah, I mean, it's the thing with all these negative and fearmonger tactics is 80% of the time, the bears are wrong. But man, when they're right, when they hit that 20% of the time when the bears are right and the market is down, they are very, very loud about it, right? There's a lot of fear out there right now. So this is what I'm looking at. So my thumbnail is a bit of clickbait because I'm not necessarily talking about free money, although it can be in the future if you basically pick the right stocks. More what I'm talking about right now with Q3 earnings season is free information, because right now what I'm seeing in Q3 earnings, you know, a company reports weak earnings. Like I said, share price is way, way, way down. You know, is that a good buying opportunity? That's the question. You have to look at risk versus reward. Some of these companies are getting pretty strong earnings. There's some pretty impressive earnings out there, yet share price is still down and or flat. And you have to wonder, is that a good buying opportunity? So right now, it's not necessarily that I'm getting good money, but I am getting good information, and share price is not going up. It's not like, you know, companies are reporting earnings and share price is up 25%. And I'm like, oh, I missed it, right? There's definitely none of that. There's definitely none of that, except for maybe D-Box. D-Box is the only one where they reported good earnings and share price is actually up. So here's a few of my questions right now. People who know me well know that I pull up this slide pretty often. This is my entire investing strategy on one slide, where I'll research a stock, I'll build a thesis on that stock, and then I'll buy. Common misconception that I'm sitting here, I'm going to buy 100% right off the bat. Like I'm going to do 12 months of research, know everything about the company, and just slam all my money into this one stock. That's not how it works. Sometimes this is a very, very, very tiny buy, just like I compare it to dating. A first date, a first kiss, whatever it is, right? Sometimes I build a thesis in 4 or 5 hours of research, and I'll buy a very small position. But the more important part is evaluating the inputs that then come in and continuing your research on a stock. And as those inputs come in, I then reevaluate or evaluate my thesis that I started with originally and see if I am correct or not, whether I like it or not, and then make that decision as to whether I want to buy more, whether I want to trim, whether I want to sell. And of course, I always seem to miss on this slide that there is a fourth option, that is simply to hold. Now, right now, my questions are, is the company improving, but the share price and valuation is not, right? Sometimes that is exactly the situation that I'm looking for, where, you know, the company is reporting good, strong earnings, share price is simply not going up because the market is bad. We're getting that a lot right now in SaaS stock. SaaS stock, software as a service, is getting absolutely destroyed, right? The other thing that I'm looking for right now, inputs that I'm looking for, are these some of these problems? If a company is reporting weak earnings, are these short-term problems? Can these be fixed, right? This is a fantastic way for microcap investors to disagree. I always say disagree with the market, where, you know, a company has a bad earnings, share price absolutely craters, but you do your research and you figure out that this is not a systemic issue. This is a 2025 thing. This is a 1 quarter problem that's going to be fixed starting next quarter. This is absolutely a way to make money in microcap stocks, is asking these questions. I think these questions should be asked all the time, but right now I think it's more important than ever, simply again because we're in quite a unique position right now where we are getting Q3 earnings and we're getting share prices going down. So don't forget, I mean, there's never 100% on anything. Investing is always that balance of risk versus reward. Keep in mind, sometimes, you know, when share price goes up and we're in a bull market, this is sometimes when we're assuming more risk, right? And what people don't realize sometimes is that when share price is actually down and we get a bear market, sometimes that's when some of these stocks, not all of these stocks, are potentially into the territory of having higher potential reward because their valuation is lower, the company is potentially improving while the share price is not. So that's the type of situation I'm looking for, always balancing that risk versus reward. And that's why, yes, do not get me wrong, I prefer bull markets. I prefer making money. That is when I'm the happiest, but I'm happy all the time because I don't mind these bear markets. You can call me crazy if you want, but I do sometimes like these market corrections where share prices are going down and some of my favorite companies has basically been going down in price for not no apparent reason, but no fault of their own. Okay, so let's take a break from the rant on some of the macroeconomics and we'll talk about a few specific companies. I'm going to start here with AudioEye. I may have covered them on the last stream, I forget, so I'm not going to talk about them a lot, but this is one example. I made a video on YouTube for Audio Eye. I think that video, I introduced the company at $12.88. I liked Audio Eye at $12.88. That's obviously why I chose to make a video on them on YouTube at this price. I was right for a while. Share price went well up over $15 until earnings hit, and share price is way down. Right now, you could pick up Audio Eye in the $11 range. If you actually look at earnings, again, this is one of these companies that earnings were pretty good. They weren't great, but they weren't bad, right? This was not an epically bad earnings that would cause share price to drop from $15 to $11. I have to look at earnings and say that the share price drop is mostly due to the macroeconomics. Audio Eye reported good revenue growth, not great revenue growth. I think it was 7% revenue growth, but they are moving out some legacy clients for some new larger clients because their enterprise channel growth was up 26% year over year, adjusted earnings per share of 19 cents per share. They're producing cash. They have cash flow of $2 million. They're using that cash to buy shares back. They have a share repurchase program, 4.6 million in cash, and they have some available debt. Don't forget the thesis for Audio Eye was them not to have a huge breakout quarter in Q3. The thesis for Audio Eye is hopefully that they show some improvement in 2024. And if they can do that, that's an indication that their 2026 is going to be significantly improved compared to this year. When I look at their earnings here, you know, again, just looking for signs of improvement, you could see the little bit of lumpiness here as they restructure and they get rid of some of their legacy clients and replace those legacy clients with larger, higher paying, higher margin customers. But you could see this continued trend. Revenue is moving up. This was not a bad quarter. You know, earnings, they're getting a little lumpy, but they're still closer to positive than they were previously in 2024, 2023, or 2022. So again, earnings for Audio Eye look pretty good. But here's the question, and it's the interesting thing, and why I like this time of year sometimes is that I have my own price targets here that I have in the Discord for Audio Eye, where I think they can go in share price over the next 1 year and 2 years. And you definitely have to look at opportunity cost. When this company was $14, $15, again, like I said, sometimes share price goes up and you're actually taking on more risk because your valuations are higher, right? You're paying more for the future. Well, in this case right now, you know, was Audio Eye at $14, $15, maybe a little bit overpriced? Potentially. So people have to look at it this way. But now that it's back down to $11, all of a sudden your opportunity cost gets a lot more attractive. So I think Audio Eye is one of those companies that, you know, free information basically for me. They had maybe not strong earnings, but their earnings were on track. And I have to wonder now that share price is down, is that potentially a good buying opportunity for Audio Eye? That's an American company on the NASDAQ, by the way. Symmetrix, here's another one in Symmetrix, right? 40 cents Canadian, reached a high, 40 cents Canadian before earnings, releases earnings, and now share price is down to 33 cents Canadian. So, you know, you look at this chart and you just say, well, earnings must have been really bad. And then you go look at earnings. They weren't bad at all, right? 3.2 million of operating cash flow. So they produced 5.6 million of operating cash flow in the past 9 months, and 3.2 of that was this quarter. That's a really nice quarter, right? Year to date adjusted EBITDA is a record of $5.9 million. Previous record was $4.9 million. So they produced $5.9 million. They still have one more quarter to go. So they've already beat their previous high, and they have another quarter to go. And they're saying that the next quarter, this is a seasonal company, is very busy in the first 6 weeks of the fourth quarter and then slowing down in the last 6 weeks. Still pretty good for a seasonal company, right? Records. Share price is down. And I think companies have to be aware sometimes is that, you have to look at whether or not you're an investor or whether you're a trader. I talk about this quite a bit as well, right? Are you buying this stock for the long term, or are you buying this stock for the short term? And I have to say, sometimes companies, I feel like CEMATRIX has done it to themselves a little bit with some of this volatility. Here in 2024, they went up to close to 50 cents. I think they went to 55 cents Canadian, and they had a financing. And I think that really pushed out a lot of good investors out of the stock, and it's left them with more traders than investors. And what's happening is that this company, because they're going into the winter and they're going to slow down a little bit, people just wanted to lock in their profits. And despite CEMATRIX having a really good quarter, share price is down. Now, when you look long-term, if you're a medium-term, long-term type investor, Russell Stanley at Beacon raised the price target from 55 cents to 65 cents on CEMATRIX, saying that the quarter was a really good quarter, beating expectations. And right now, share price is only at 33 cents for CEMATRIX. So that's very interesting to me. You know, again, it comes down to some of these companies, especially the Canadian microcap stocks. When I look at some of the US stocks, you know, they're sitting at EV to EBITDA ratios at 20 times, 30 times, 40 times. And it seems like in the Canadian microcap space, we're struggling to just hit 10x. I think right now, based on this valuation for CEMATRIX, they're potentially next year in 2026, they're potentially around a 4x EBITDA multiple. I give my thoughts on that, of course, on my private live streams on my Discord, and I include all of my calculations on what I expect for CEMATRIX over the next 12 months and where I think their valuation could go in the future. But this is another stock, right? This is just another company in Q3, maybe not giving me free money, but definitely giving me free information. They had strong earnings. Share price is down 7 cents from 40 cents to 33 cents. You have to wonder, if you're a long-term investor, if CEMATRIX can build back their good quality, high quality investor base, is it a good buying opportunity for CEMATRIX, right? Look at this. Hi, Cam. Just wanted you to know that I'm tuning in from my hospital bed, enjoying the show. Well, I hope you get well. Is wishing you well wishes as well, Jeremy. That's fantastic. I mean, not fantastic. You're in the hospital bed, but I think that's one of the more unique places that somebody has been watching Common Sense Investing from. So far, I think the most unique place was probably camping. I think one person was camping in a canoe. But hospital could be taking the cake. Speaking of taking the cake in the opposite direction, basically exploding the cake on all their shareholders, is NTG Clarity Networks. So previous high, right, in 2025, $2.95 Canadian, now down to $1.11 Canadian. I think today they were at $1.12. Right? Opinions very volatile on social media here. We got people very disappointed in NTG Clarity Networks, right? Once bitten, thrice shy. Now I'm a bag holder. People considering themselves bag holders and calling NTG Clarity Networks garbage. They have dropped over 50% in share price. That is a problem. It's hard to argue with this type of statement. At the same time, are you a trader or are you an investor? There are people that are pointing out that the company is hiring. You know, Q3 showed revenue growth, but temporary negative cash flow because they front-loaded hiring in offices. So this is another company in NTG Clarity Networks that is investing right now for growth tomorrow, and that comes with risk. Bravo here is saying that the market is panicking and overreacting to the short-term numbers while missing the bigger picture. So who is right in this case? Who is more right? It's interesting here that myself and Wolf of Oakville don't agree all the time, but sometimes we do, right? This is Wolf's Substack post right here on NTG Clarity Networks. downgraded them to 3 stars. But again, with the market panicking, it's not like Wolf went to 1 star or 2 star. It's not like NTG Clarity Networks absolutely shit the bed. They are having a few issues in 2025 and they deserve the downgrade. But even Wolf here says that with all the problems in these numbers year to date, it currently trades attractively at a 9 times P to E and under 5 times EV to EBITDA. It comes down to investors' belief in improvements into 2026 and beyond. So can NTG Clarity Networks get these improvements? Because they're a very high growth company, and that comes with challenges. So back here in 2023, NTG Clarity Networks got 57% revenue growth, and they had a conversion to net income of only 8.35%. What caused that massive spike in share price, where you see share price going from basically nothing to $2.95 Canadian, is this year in 2024, where they got 100% revenue growth and 17.55% conversion from revenue to net income. Is that sustainable? Of course it isn't. That is a fantastic, blow it out of the water year. Stunning growth for NTG Clarity Networks, but there's no company in the world that can maintain this. So what we're getting here in 2025 is another year of consolidation. Growth is a little slower, although 52% growth in revenue, is that really slow? The real problem here is NTG Clarity's conversion to net income. This year, they are paying taxes for the first time ever, right? They've been hiring for growth. I'm sure they're paying some higher wages because of inflation. They have all these expenses coming online in 2025 for growth into 2026 and 2027, and it has absolutely crushed their net income. So you have to look at a company like this and say, well, what's the normal, right? They seem to bounce between 8%, 17%, 7%. Where is this company going to land long term? Can they land in 2026 at a 10 to 12% conversion of revenue to net income? Can they get higher than that? Do they disappoint again and get lower than that? I don't know. But Active 8 Capital is taking some guesses on this. This is a free report provided by Active 8 Capital, speculating on where NTG Clarity Networks is going to go into the future. Right now, they are saying in 2026, they expect NTG Clarity Networks to get $101.1 million of revenue. And yes, they expect, like I said, that net income margin can go from 10 to 12% potentially. They're actually saying that they're forecasting for higher at 12.9% net income margin, which they're saying is going to basically double, just about double the net income of NTG Clarity Networks in 2026 from 6.6 million in 2025 to 12.8 million in 2026. Now, there is a disclaimer here, obviously. Active 8 Capital does own 195,000 options in NTG Clarity Network. So they are motivated to, basically point out some potential bullish, the bull case for NTG Clarity Networks, right? They're not completely unbiased, but I mean, 195,000 options isn't, you need to take that into account, but it's not huge, right? The real question here are these numbers real? I break down what this means for valuation in my Discord. And again, it comes to the question of, what type of valuation metrics is reasonable for NTG Clarity Networks, right? What can they get to? If you believe they can actually get to these numbers in 2026 and report $12.8 million in net income in 2026, can NTG Clarity Networks get a 10x multiple, an 8x multiple, a 20x multiple? Where do you think that this company can go? So right now, it's down substantially, right? $70 million market cap right here. But this is what Active 8 Capital says as a conclusion for NTG Clarity Networks. They say that following 3 years of very rapid growth, we believe 2025 will be remembered as a year of consolidation, where management made significant investment in infrastructure and people in preparation for a successful 2026 and beyond. If what appears to be on the horizon materializes, that's a big if, right? They need contracts. They say that contracts are imminent, but they haven't announced the contracts yet. Then top line revenue will continue to grow substantially in a more profitable and cash flow positive way. Last quarter, we stated that expected the upfront investment in staff and resources would be short term and expect profitability for the remainder of the year to revert back to more normalized levels. The expected new contracts with new customers, which management have confirmed in their comments are imminent, have taken longer than expected to be signed, and the result has been a poor Q3 result. Agreed, right? But again, my question here is long-term systemic issue or short-term problem in 2025. Activate Capital says, however, we do expect the contracts to materialize in the fourth quarter, and our medium and long-term thesis remains in place with an expected uplift in profitability and cash flow in Q4 and over the next year or two. So a lot of people have given up on NTG Clarity Networks. As Wolf of Oakville points out, their valuation levels are quite low right now. A lot of people are quite negative about NTG Clarity Networks. Be careful. I'm seeing a lot of this, especially with new microcap investors, right? 2024 was a really good year. We had a bull market in the early part of 2025, but other than that, 2025 has basically been like this. It's been a very volatile year for microcap stocks. So just be very careful. Don't necessarily follow the herd on social media. If everybody is negative about a stock, sometimes you have to be the dissenting voice. And I'm not saying that I am, but I'm saying that right now, Activate Capital is the dissenting voice on NTG Clarity Networks because they're saying that they are going to recover in 2026. So NTG Clarity Networks, is it this type of company? Reports weak Q3 earnings, but it's short term. They're going to have a return to normal in 2026. Is that a good buying opportunity? That is the question. You know that we're in a bear market when people are making up problems that I've never heard of before, right? Isn't that always fascinating? Stock is going up. Everybody's happy. All we could talk about are the good things, right? We hit a bear market. Stock is a little bit weak for one reason or another. Sometimes not even the stock's fault. It's not the company's fault. It's just the market switches. Everybody gets negative and everybody starts looking for problems. When this happens, I absolutely know we're in a bear market, right? This is one right here. Auxly Cannabis Group reported earnings up. Fantastic year for Auxly Cannabis, right? Reports earnings here on earnings goes all the way up to, I think it was 19 cents where it spiked right here, just briefly, right? But 19 cents Canadian. After reporting this good earnings and after seeing this spike, it's just been straight down. People are looking for problems in Auxly. When I go look at their earnings, I mean, net revenue increase of 20%. Everything in blue, in my opinion, is good. Gross margin, inventory sold 56%. That's great. Here's one of the problems. SG&A is up 38%. That's a little bit high. Adjusted EBITDA is up 48%. Net income is up 533%. Cash flow from operations, $11 million, up 82%. Cash at quarter end totaled $30 million. This is a company where you would expect this earnings, that share price should be going up. It went up for all of 2 hours and then it started coming down in price. And one of the things I started to see almost immediately is people were talking about problems when they weren't talking about those same problems 2 weeks ago, 2 months ago, right? Yeah, there's a lot of share dilution for Auxly, right? Questions about management because of all the share dilution, but also because of all the share-based compensation. The RSUs are a problem. So all of a sudden we hit a bear market, and after Auxly has gone from 2.5 cents Canadian to about 19 cents Canadian, all of a sudden now people are looking for problems. These are real problems, but they weren't being discussed before earnings. And now that we're in a bear market, all of a sudden it's being discussed. So go do your research on Auxly, but you have to remember some of the problems they do have like the share dilution and like the RSUs, are basically because this is a cannabis company that nearly went bankrupt not too long ago. And once they solved that problem, once they started getting people on board and making the right decision, that is when share price started to go up. But a lot of times, sometimes these companies are left with the baggage, the resulting baggage due to previous mismanagement, such as paying off debt with equity. And that's why all the bloody share dilution, such as paying staff in RSUs because you don't have the cash to pay staff, right? So when companies have these problems in the past, there is some baggage. You need to make sure you understand what's going on. But I do find it interesting that people are looking for problems with some of these stocks because of the market we're in. This is another one. I thought earnings were really strong. Share price is down. Is that a good buying opportunity for Auxly, despite some of the issues that they 100% have, right? BioRem, I think they just reported today, down 30% on the year. This is a really good company to be down 30% on the year. They were down below $2 here at one point, Canadian. They're back up to $2.15. One of the problems that everybody knew about with BioRem reporting earnings was their year-over-year comparable. This was a stunning quarter last year. That's the quarter that they were reporting against this year. So last quarter was good. That's a tough quarter to beat. And year-over-year, the quarter was stunning. So that's a hard quarter to beat, right? So when you look at what they reported, or the thesis here is brutal year-over-year comparables. Do they get capital loss selling? This is truly one of those situations where I thought we were going to get free information because last year was such a hard year to beat that we would be able to see Q3 get reported. How's the economy? This is a company that really relies on the economy to improve. So Q3 earnings from BioRem are a good indication of where the economy returning to normal or not, right? BioRem looks to be returning to normal. If I'm just looking at earnings per share, right? They reported 6 cents earnings per share fully diluted in their Q3 3 months, and they only reported 10 cents so far this year. So 60% of their EPS was reported in this quarter. This is a good quarter. This is a return to normal for BioRem. Share price is back up just a little bit. You could just barely see it, but it is. You have to trust me. So this is, like I said, one of those companies very much relies on logistics, right? They had shipping issues, they had contract delays, they had wage issues, they had everything that could have gone wrong from Donald Trump, and everything that happened with tariffs went wrong for BioRem in 2025. So if I'm looking out to 2026 and I'm looking at, is the logistics of the economy improving, right? Is there contracts now getting executed again? Is shipping returning to normal? Are people spending money, spending CapEx again, moving forward with projects again? BioRem is a fantastic company to look at for a barometer of the future into 2026. And I would say, based on this quarter from BioRem, it does look like at least this niche part of the economy is somewhat returning to normal. This makes me very, very excited for, again, 2026. So this is another one for BioRem. Strong earnings, in my opinion. Maybe not strong, but at least back on track, back on the rails, right? Is that a good buying opportunity? That's another question. You have another good company that's down, that's had a really tough year. Is it just a really tough year, or is it a systemic issue? That's one of those things that you always have to ask yourself. Are you a short-term trader, or are you a long-term investor? How much value do you place in these tough years versus how much value do you place in the quality of the company and where it can go into the future? This is my last one here today. It's the only company in this presentation that has not yet presented Q3 earnings. I think it's coming up in what, a week or 2 weeks? This is the 6-month, 2-hour chart. Zoom Technologies, massively down. Similar to, not quite getting there, but similar to NTG Clarity Networks, right? NTG went from $2.95 down to $1.10, and right now Zoomed has gone from $2.75 or whatever it got to, and now it's down to $1.86 and still looks pretty weak. It had a little spike down here. Look at that red. Absolutely fascinating. This is I think up to this point was the most successful stock in the past 12 months. It's just up massively. And now all of a sudden down, 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 down. This was zoomed not at this share price. This was at this, $2.65 share price not too long ago when they were presenting at different investing conferences. You remember I said we're going to get that little block of time in here, investing conferences, small cap discoveries, Planet Microcap. We're going to get a little bit of a bull market. We got a little bit of a bull market. And ever since that has ended, all of a sudden share price is down. Why is it down? I don't know that we know. Right now, it's interesting because ATB finally opened up some coverage on Zoom Technologies. They actually gave a $4 one-year price target for Zoom Technologies. That was when their share price was at $2.65, and you're looking at that $4 and just kind of drooling. Now it's down to $1.85. That is very, very interesting. Basically, this was an absolute jinx for the company because ever since ATB released this $4 one-year target on their share price has been absolutely crashing. It's interesting, though, it does give us some numbers to work with, assuming ATB and Martin Toner put in the work to actually talk with Zoom and figure out that this is what their expectations are for Zoom in the future. Right now, Zoom has a market cap of $205 million and a $188.5 million enterprise value. They have $16.5 million of cash and no debt. Go run the numbers, go run the valuation metrics on what ATB is talking about, how they got to their $4 price target compared to where they are right now in their share price. And right now, Zoomed, high growth company producing cash like crazy, is sitting at a PDE of only 9.32 times. They have a 28% conversion of revenue to net income. Remember NTG Clarity Networks? Down to 7% this year. Last year, they were at 17%. This was a fantastic year for NTG Clarity Networks. I'm hoping NTG can normalize to about 10, 11, 12%. And Zoom Technologies is blowing that out of the water at 28% conversion right now. And yet their PDE is only 9.32. So I say that, there's not much more Zoom can do. They need valuation improvement. They need this number to go up. They really do. They've been executing as best as they can as a company. They need valuation improvement, or I think they should just sell. I mean, if the market is not going to give them fair value for what this company is worth, they should seriously look at buyers and try to get a reasonable multiple on a sale, because this is simply not cool. So I know the expectation is that the rumor is they're going to have a weak quarter, right? The expectation is they're going to have a weak quarter. And because of that, share price is already declining on expectation of a weak quarter. Zoom so far in 6 months has produced something like $8.8 million of operating cash. They've had a fantastic first half of the year. If they, again, are you a short-term trader or are you a long-term investor? If they have a weak Q3, if share price continues to go down, I have to question, whether or not Zoomed is going to be another good buying opportunity for the future into 2026. So what do you think? That's it for my presentation. What companies did I miss? What companies do you want to talk about? That's what I'm seeing so far in Q3 earnings. Those are some of my common themes, right? Still getting some revenue growth, but that revenue growth is costing more, expenses are higher, margins are down, and the market is panicking. So S&P 500 is down 4%, but when your favorite microcap stock has expenses higher than their revenue growth, people are selling, and microcap stocks and small cap stocks are getting absolutely obliterated right now. That puts a smile on my face because I think that normalizes in 2026. What do you think? Am I wrong? Am I full of it? Do you think we get a terrible market in 2026? What else do you want to talk about? Now is your chance. Right after I have a little drink of tea there, because I cannot keep my voice together without it. It's not coffee. I quit coffee now 2 weeks and 2 days since I've had a coffee. I used to drink about 4 cups, not 4 cups, 4 of these at least a day of coffee. And go drink that much coffee and then try to quit. It's tough. Brain fog, headaches, fatigue. Oh, you realize what coffee does to you. CRMD. Yeah, that's CorMedix. So I'll pull that one up. So there's a rumor going. I'm not much of a conspiracy theorist, but sometimes when the shoe fits. So there's rumor that in one of their acquisitions with CorMedix that they basically baked it into the share price where they have an at-the-market offering and people can bring shares to the market. And what's happening is this company is getting traded by insiders is basically the conspiracy theory. And so what's happening with share price is that they're trying to keep share price within levels, and basically people on the inside are, putting these shares out into the market, buying low and then selling at this range and just doing it over and over and over again. I don't know if that's true or not. I think the hard part with CorMedix is this is a very complicated company to value. They're producing a product into the market that's producing a lot of cash now, but it's going to lose cash pricing power in the future, and people don't know what to do with that, right? So you're producing cash now, you're going to produce less cash in the future. They're using their cash today to acquire other companies, but they're acquiring other companies with other drug products that are also high risk. So this is a high risk, high return company, but basically the rumor right now is that share price is going to stay like this in this range until they get more visibility into the products, right? So they de-risk the company a little bit, and or insiders stop manipulating the share price of this stock, depending on whether you want to look at the financial reason for why share price is volatile, or whether you want to look at the conspiracy reason for why share price is volatile. We have a lot of conversations about CorMedix on our Discord, and I think if you like this company, again, I think you have to be a long-term investor. They're taking on a lot of risk. If you look at the previous share price, right, it's also been consolidating, which is hard to do. We see this a lot where a company was at a certain share price for a long amount of time. It's now gone up in price. This was in late 2024. So it's basically been consolidating for the past year. We can complain about some of this volatility where share price is pretty volatile. Be careful of where you buy this stock, but it's not like it's down. It just hasn't shot up. So they need something to prove to the market, better transparency into the future, more consistent ability to determine their outlook. And that, in my opinion, would cause the next bench up for CorMedix, but right now they're not getting it. They're just getting consolidation, and they're getting people trading the share price. So that's my opinion right now. I like the company, but because it's basically a biotech company, you have to put in a lot of research, right? So they're commercializing therapeutic products for life-threatening diseases and conditions. That is always a unique investment that's harder than some of the other stocks that I cover. It typically requires some expertise in this area. So be careful when you're investing in CorMedix. It's the type of company that takes a lot of research. But I do think, or at least hope, that they are producing a lot of cash. Right now, at least, they're producing a lot of cash. They're expecting $100 million in cash by the end of the year. I don't like betting against cash producing companies. That's why I made a video on CorMedix. I was basically like, look at how much cash they're producing. This is absolutely incredible. And I'm never going to bet against a company that produces a shit pile of cash. Sorry about the incomplete message. Pivottree has made the turn. Cash flow from OPS positive, operating income positive, and free cash flow positive. Your thoughts, please. Yeah, so, I mean, disclaimer, I bought a little bit of Pivottree a little while ago. I've actually, I bought it once and then sold it because share price went up a little too quickly for my taste. That's the one-year chart. Did I make a video on Pivottree yet? I think I did. So this is another company that's cash, right? Producing cash. So they were restructuring the company. They were doing a turnaround, quote unquote turnaround story, but they were still producing really good cash. I introduced the stock, I think it was at $1.30 or something like that. I made a video on it. Share price ran all the way up here to like $1.70, $1.75. I was like, this is a little bit too high too quickly. So I ended up, I bought shares down here, I sold shares down here, and then recently on their earnings, I agree with you, they did have a really good earnings. And I ended up buying again at $1.60. Not a very large position, but you know, if this company can complete the turnaround story, again, I'm not going to bet against a little microcap stock, $42 million market cap company that's producing cash. I thought earnings were really good. I mean, good enough that I said, I don't really care about share price. I'm not going to try to time the market. I basically bought the price on earnings day, and I'm willing to see where Pivot Tree goes. It does look like they are completing their turnaround story. I completely agree with you. When you look at their earnings here, right, we'll pull this up just quickly. Net income of $900,000 compared to a loss of $5.1 million for the prior year. That's huge, right? Adjusted EBITDA of $1.8 million compared to negative adjusted EBITDA loss of $800,000 last year. So significant improvements from Pivot Tree, and I do wish them quite a bit of luck. It's an interesting little company. This is another one they're using AI to compete against AI. And that the concept of that is very interesting. Glow, that's let's see here. That's the cannabis stock, little 5-cent cannabis stock, Glow Life Tech Core. I'll tell you what the next step is for Glow is to just get back on track. So remember their last earnings, they showed no revenue growth. If I go to the press release, if I could find it here. So there's one thing here. They reduced their overhang of warrants. They have 70 million warrants as an overhang against the stock. That is absolutely brutal. They reduced it recently. Some of those warrants were exercised at the current share price, which is good. But if I could find it, I'm not seeing it here. Was their recent, because this is a small stock, it's not always in the news, but their recent quarter showed zero revenue growth. That's not good. Like, this is a company that I was modeling to get 20 to 40% revenue growth quarter after quarter after quarter after quarter, and last quarter they failed. They didn't get that. So that's why share price is down, also with that share price overhang. So the next step for this company is they just did announce news that they are expanding across Canada. They're going to Saskatchewan, a few other provinces. They need to get continued revenue growth. They absolutely do, because they need to grow into their valuation, in my opinion. Like, I know this is a tiny company. This is a $9 million market cap company, right? So you think, oh, that's super cheap. But when you go to their financials, they only produce trailing 12 months, 1.462 million. So this is still sitting, you know, at a 6 times sales. So valuation is pretty high for Glow Life Tech. They need to work their way up into that evaluation, into that valuation, and then hopefully blow through it. But the only way they're going to do that is by getting growth in revenue and high quality, transitioning that to the bottom line. Last quarter, they failed at doing that. So they need to start returning to this 20, 30, 40, 50% growth. That would be the next step, in my opinion, because they need to catch up to their valuation. Let's see. This is still funny. I hope hope everything's good. I hope you're feeling better, and I hope you're healthy. I hope it's a good surgery. I know in my family personally, we've had a lot of surgeries. It's been a year of surgery. I can't wait for this year to end. Agnico Eagle bought into Canada Nickel a while back. What's your thoughts on CNC.V? I have no thoughts on CNC.V. I think I made a video on them 2 years ago. I am typically not a resource stock channel. I don't wade into copper, nickel, or anything else. I am the type of investor, you know, the old cliche that in the gold rush, it wasn't the people who were searching for gold that made the money. It was the people who sold the picks, the shovels, right? All the supplies, the services. That's what I'm looking for. So I've made money in resource adjacent companies. I love resource adjacent companies. Enterprise Group, it's down right now. It's not my favorite stock right now, but it did very well for me a couple years ago. Right now, McCoy Global, same thing, oil and gas adjacent company. It's a tech company in the oil and gas space. Those are the types of companies that I look for in the resource space. I don't have an opinion on Canadian nickel because I don't really follow resource stocks. It's a different, resource stocks are a different space. I've invested in them before. To me, it's the space where it's not what you know, it's who you know, who you're connected to, who your network is. You get information on resource companies that you can get information on resource companies that your average investor cannot get if you have the right connections. I don't like investing in that, right? Where it's who you know, not what you know. And the other problem with resource stocks is 5 or 6 years every time. I'll beat resource. I have friends that invest in resource stocks. I'll beat them for 4, 5, 6 years in a row, and then they'll crush me for 1 year, right? And then I'll start beating them again, 2 years, 3 years, 4 years. They're stubborn. They won't get, and then 5th year they'll crush me again, right? So I will take that 30% compounded every year kind of win over that, you know, losing money for 5 years and then getting that 6th year that's 100% gain. So that's my type of investing style. I bought DLO on the dip on Wednesday, report the best quarter that looks undervalued. Look at DLO earnings from last week. That looks like no debt. I can go take a look. Never heard of this company before. No idea who DLO is. Do I use level 2? For instance, you want to make your first purchase of Sabio, but you see there's 500,000 on the ask, but only 35,000 on the bid side. Do you hesitate to buy and do more research? No. So I don't. I do have level 2 on US stocks. I do feel I benefit more from level 2 data on US stocks because US stocks are very volatile. You can get a massive range in US stocks. There's way more traders in US stocks. There's more people shorting it. There's people hedging. You know, there's more volatility in the US side of things. So I love having the level 2 data for US microcap stocks because you do see that bid and ask range, and you can also see a little bit more on where the bids are piling up, where the volume is, right? You could pull that up. In Canadian stocks, the companies that I cover are so illiquid that the level 2 data, in my opinion, doesn't provide high quality information, right? When you have a stock that's only selling 10,000 shares a day, the level 2 data doesn't have the same information to me that a company that's selling 1 million shares a day does, right? The information quality isn't just there. So, I mean, you use a company like Sabio, it might have, what, 2,000 shares on the bid at 38 cents. I mean, how much money is that, right? That's, you know, that's not a lot of money. We're talking like $700. So if I use level 2 data for a company like Sabio and I'm like, okay, there's 2,000 shares on the bid at 38 cents, that's like the first $700 just blows right through that. So level 2 data for me on Canadian stocks, I don't really use it. I don't pay for it anymore. I didn't keep it. I do keep it for the US microcap stocks due to the volatility. Bought Oxley at 18. Going back to this, like for me, keep in mind, I'm more of a fundamental investor, right? So I hate to say it, but I try not to, especially for new investors, I try not to focus too much on like the half penny nitpicking, right? If I'm bullish on a stock and I think it can get to 80 cents, do I really care if I buy it at 38 cents or 39 cents, right? If you do that research, it's more about being right about that price target and that time target rather than saving that half penny at the bottom. So that's the other consideration that I have. I typically suggest that most new investors use Wealthsimple because it's got free trading in Canada, and even Wealthsimple will only let you increase or decrease the bids by a half penny. So you can't go down to any fractions. And so, yeah, the level 2 isn't worth it. Bought Oxley at 18 cents before Q3 results, thinking it was a steal. Q3 comes out, very impressive numbers, but now 15 cents. Yep, that's the market we're in. People found problems with it. And there are some problems. Like I said, you need to make sure that you're comfortable with some of the risks. But here's the thing too, is remember back on that other slide I showed you, and this is why it's so important to have a plan and gain a little bit of experience in microcap stocks, right? When I go here, you have to keep in mind that Oxley is up significantly and we are in tax season. So there are people selling for capital gains, right? When I go to Oxley, when I go to their chart, XLY.TO, if I could type properly here, and I'll show you their chart. You look at the 1-year share price, it's up 342% in the past year. If I go to their year to date, right, 342%, so the same price. If you took the risk to invest in Oxley at 2.5 cents when they just about went bankrupt, and you're now sitting there on earnings and it's up to 17, 18, 19 cents, I guarantee you're trimming, right? You're locking in some of the, even if you love the company, you're up 342%. You've lost money on some other stock. It's down 50%. You've got some capital losses. You need one stock that you need to sell to lock in some capital gains and, you know, lock in that profit and walk away with the money and take your wife for a nice dinner. Oxley is that stock, right? So that's the other thing, is some of these people that are looking in tax season, looking for a company that they can trim or sell for capital gains. They will look at a company like Oxley, predict that they're going to have a good Q3, and intentionally have asks for sale on 18, 19, 18.5 cent levels to try to lock in some of the profits. So that's unfortunately the way it goes at this time of year. That's why I tell people, and that's why I bring up this chart and show you all the time on these presentations, right? This is a very, very volatile time to be investing in microcap stocks. Why do you think on all my videos, if you go look at Common Sense Investing, and I make those videos, top stocks for 2025, top stocks for 2024, you will notice one common theme on all my videos. I always make them right here. Right there. Late November, early December is almost always 4 times out of 5 the worst times for microcap stocks. I make my videos, top stocks for next year, not on December 31st, not on December 25th, and that's not because of Christmas. I always make my videos around December 10th, 12th, 15th. I do that intentionally because that is usually the worst time of year for microcap stocks. Right? So very, 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 very volatile time of year for microcap stocks, and usually volatile down time of year for microcap stocks in late November and early December. So be very, very, very careful. Although it's a little too late. You should have watched my videos for the past month or two, and I've kind of been talking about this, where November and December, very tough time for microcap stocks, right? My several portfolios are down slightly for this week. That aside, one issue just can't move into the green. McCoy Global, thoughts? Well, again, I think McCoy Global is one of those stocks where, I've said it a few times now today, but are you an investor or are you a trader? I mean, you could see down here, oil, 59 bucks. Oil isn't moving up high. McCoy Global is an oil and gas adjacent company, and they require drilling companies to contract and buy their products. Right now, it's my understanding that drilling in the United States is down, right? You're not going to drill with a price of oil that's so low. So I know Trump came into office and was like, drill, baby, drill. That's not necessarily happening. Where McCoy Global has been doing fairly well is in the Middle East. They have had some success there, more success there than they have in the United States. The problem is with McCoy is they're relying on some larger contracts coming in, and they haven't really came in yet. They have a bid for a significant amount of rigs in the Middle East in 2026. And apparently they have a bid on an even larger amount of rigs to buy their products in 2027, right? That's 2 big contracts in the Middle East. I haven't heard of anything in the United States. So that is the concern for me. Again, this is always the tough time of year for microcap stocks. People are looking at rebalancing their portfolio, and I think a lot of people are looking at McCoy Global, maybe started taking some profits from here to here. You know, do you want to hold into late 2026? Do you want to hold into 2027? The contracts aren't a guarantee. There's some risk there. There is some risk there. So this is a very, very good company. I absolutely love McCoy Global, but even myself in my Discord, I did move it down the list of top stocks because there's not a lot of microcap investors that will sit here and they'll look out 1 year, 2 years, 3 years, 4 years into the future. That's kind of rare. A lot of microcap investors, they want returns in 3 months, 6 months, 9 months, 12 months, right? Even myself, typically, if a company can't make me money in the next 12 months, I'm probably not interested. I know myself personally is that I don't have that type of patience. I have trouble sitting on a stock for 12 months. I'll see some other opportunity that I think is going to make me more money in the short term, and I'll just think, look, I'm going to move some money from this long-term stock into this short-term stock. I'll make money over here. I'll come back to this other one later. I know I'm going to be okay because price isn't going to be super high. Is that happening with McCoy Global? I can't say for sure, but that's kind of my thought process is that, you know, I'm seeing some companies right now that I've been talking about in this video that are, you know, significantly improving. Price is down, valuation is low, and I think I can move some money into these stocks. I'm probably going to make money by the spring of 2026, and then I can trim those stocks and move it back into my longer term stocks. So in my mind, I don't know for sure if that's happening with McCoy, but I could definitely think maybe. What's your thoughts on Rumbu? It has been in my list to dive into for a little while now. I don't have enough information on it yet. So here's the tough part with Rumbu is that this is a funeral home stock. So this is a bunch of funeral home directors, and they bought their own funeral homes to start the company. So they've basically gone from individual funeral home owners into this public company, and the investing thesis is that they are going to roll up the funeral home industry. I love the idea. I think it's fantastic, right? And that it got a lot of attention from some microcap platforms recently. Geo Investing covers Rumbu. I believe Small Cap Discoveries. I think all the microcap stock platforms know about Rumbu at this point. Because of that little bit of discovery, it's already up 100%. And there's very little information on how they actually intend to do this strategy. They need a financing. They're out of cash. I don't know how they're going to get money. I don't know what their intention is, where they're going to spend the money, what funeral homes they're going to buy. I just haven't had a lot of information. So this company right now, I absolutely love the idea, and I think it will perform very, very well in the short term. Here's my problem with Rumbu is that you buy a funeral home. How much does a funeral home make? Maybe you buy a funeral home for what, $1 or $2 million, right? Maybe it produces what, $200,000 of cash flow? More? Less? It's not producing a lot. This is very easy to do when you're a $14 million market cap company, right? So in your first 4, 5, 6, 7 purchases, you buy a funeral home for 1 or 2 million and it adds this type of cash flow, and all of a sudden your earnings look really good, really improved, up 20%, up 30%. That's great at the start. Once you start making like $20 million a year in revenue, and you're buying these funeral homes that are making $1 million in revenue, $2 million in revenue, all of a sudden it takes many, many, many more acquisitions to make your earnings look good, right? It's just the scale of the numbers. For a comparison, go look at like Volatile Health. They do the same thing, but in home service care providers. And they did really well at the start because they went from 0 to 10 service homes very quickly, right? And it's like, oh my gosh, look at the growth. And then they've done very, very little over the past 2 years because they had to pay off those acquisitions. And now when Volatile Health acquires a new funeral home, we're talking about 3% revenue growth. So to get 10% revenue growth, they have to buy 3 service homes per year. That's very, very hard to do, right? So I think short term, it's got a lot of potential. I don't have enough information right now to figure out how they're going to succeed at this business, right? They're not market capital specialists. They're funeral home owners. And you know, I think short term they do well, but I don't really understand the long-term strategy. Typically for me, one of the problems is when a stock is this popular this quickly, I do find that I tend to trade it and I'm not as excited to own it, right? It's kind of already discovered. There's already a bunch of people talking about it. So it doesn't have me as excited as maybe the rest of the market. Now, I could be wrong. Like I said, I think it is a good company. I like the idea. I think in the short term, as they acquire their first, you know, I think the next 2, 3, 4, 5 funeral homes that they purchase, people are going to go wild. And I think the stock is going to go, absolutely, it's going to go up. I just don't know what this company looks like in 2 or 3 years, right? I really don't. So in my opinion, Glow needs to sustain cash flow positive, then announce an NCIB and a reverse share split. You were spot on with the revenue growth. I anticipate it happening, but we'll be watching closely. Absolutely. It's interesting to me because, again, you have to have, it's okay to be wrong, but you need to build a strategy, right? You need to do enough research on a company when you buy it to be able to build a thesis and then test that thesis. So when I get people asking me about a company like Glow, you have to keep in mind, even though it's a tiny little Microcap, some of the newer investors are like, oh my gosh, it's only $8 to $9 million market cap. Sure, but it's only got 1.4 million of revenue. Right. That's if you actually look at it on a pure valuation level, pure valuation basis, Glow Life Tech is actually a very high valuation. It needs to grow into that valuation, and it needs to do that. That's the tricky part with these companies, like you're saying, Scott. They need to sustain cash flow because we don't want more financings. They have that massive 70 million, 60 or 70 million warrant overhang because of past financings that were absolutely brutal. We don't want to see that again. If Glow needs to do another financing, that's a huge problem. So they need to grow revenue. They need to self-fund. And they need to get rid of the remainder of their warrants, in my opinion. And then if they can do all that, you know, we'll see where they go after that. Let's see. Yeah, brothels nearby make a lot of money. Yeah, I bet. Have you mentioned Zoomed, Nurse, or VST? Yeah, I talked about Zoomed. I'm not talking about Nurse or VST today. It'd take too long. They have earnings coming up as well. Fascinating company. I can't wait to see what happens on earnings. Some people think earnings are going to be explosive this quarter for Nurse, for Hydrate. I like the company. I own a few shares, not a lot. Cannabis is scary after the recent blow against the industry within U.S. Congress. Continuing resolution, Canopy, CGC down 25% this month. Yeah, but I like that, right? That's typically what I'm looking for sometimes. If I could find a scary industry that's at bottom, that's got nowhere to go but up, it could take some time. I don't mind that sometimes. Cannabis is one of those spaces I do feel like my take on cannabis is I'm a long-term investor. I dedicated 12% of my portfolio to about 6 or 7 different cannabis stocks. All the stocks that I picked are cash producing, right? None of them are cash burning. Or they're close to cash producing anyway. I don't expect any more financing. The only one that might have a financing is Hash, but that's a different story. But I mean, Oxley, Decibel, I've got all the best, Canara Biotech, I've got 12% of all the best cannabis stocks. if the industry improves while these companies are improving, I don't expect it to happen in the next 6, 9, or 12 months. I think it'll take 6, 9, or 12 years, but I think the potential is there. I'll definitely take like an industry sector that's in the dumps, like cannabis, compared to like, I mean, you look at the craziness and volatility right now in artificial intelligence, very hard to predict. There's a lot of ways to make money in AI right now, but there's also a lot of ways to lose money in AI right now. So that's typically not my favorite. What are your thoughts on sewer robots and name silo? Do you believe they'll be able to ramp up quickly? Yeah, I mean, the company is owned and operated, or owned at least, not operated, by Paul Andreola of Small Cap Discoveries. He's a brilliant capital allocator. He understands profitable growth more than 99.99% of, a lot of the CEOs and other management groups out there. So I do believe that if the demand is there, they will find a way to scale up quickly. I do think the demand is there, and that company has some cash coming in from name silo. So there's a lot of potential tailwinds for that sewer view, and I don't think the market fully appreciates that right now. But yeah, that's a pretty good looking company in my opinion. Problem with Canopy is that it doesn't make income, and that's just it right there. Just about every cannabis stock I own right now is producing cash. I mean, go look at Oxley, right? It's producing cash. So industry sucks, but the company is producing cash. Everybody hit the like button. Thank you. That's good timing. It looks like I'm finally done. I'm an hour and 15 minutes into this live stream. I think I'm just about out of questions and comments. I sold McCoy near the highs, not getting in until a better entry price. And that's a fantastic comment to end this presentation on. I will say here, right, the one thing that's really, sometimes long-term investors outperform short-term investors. I will say that so far in 2025, the thing that has saved me and saved my portfolio and made me a lot of money in 2025 where I could have lost money was trimming. Maybe not selling 100%. I'm not necessarily a 100% seller. I typically don't buy 100% to start and then sell 100% at the top. I don't think that's realistic. I typically buy in little pieces and I sell in little pieces. But I'll tell you, there's been a lot of stocks this year. Here's NTG Clarity Networks in 2025. Just in June, it was $2.95, right? You were talking about McCoy Global. This is another stock here. We could look at year to date, right? This was $4.42 in July, and now it's down to $2.89, right? We can look at Zoomed. This is another one, right? Year to date, we could look at back in August, September, $2.45. We could look at $2.61 in October, and now it's $1.86. This year has been the year of, I think, people that have been willing to trim, recognize that the markets are a bit high, recognize that the markets are volatile. I think people that have been willing to trim their portfolios in 2025, this is one of those years where they have outperformed the longer term investors. It's just the way it is. There's a lot of companies this year that have basically been flat for the year over year gains, but at some point in 2025 they were up 100%. Right? It's amazing how many stocks like that are out there right now, and so at some point I'm going to do like a looking back in 2025. What did we learn from 2025? And I'm not saying that this is going to be this way every year, but I think because 2025 was so volatile, Donald Trump, tariffs, trade wars, rate cuts, recession, like all the chaos that's been coming coming in 2025. It's been very volatile. So I think this is one of those years where if you're willing to maybe add on some of the weakness and trim on some of the non-weakness, some of the bull runs that we've had, I think that you've probably outperformed your friend who's been the buy and hold investor all year. it's just the way it goes. So next year the buy and hold investors might win, but this year I think it was some of the shorter term investors that were willing to lock in some profits that really outperformed. So you're welcome for a great show. Thanks for being a great audience. I will see you again in